One of the more provocative experts on global markets is Dr. Mark Faber, a former managing director of Drexel Burnham Lambert, but for 2 decades now he's been an investment advisor, fund manager and broker-dealer. And he's also the editor and publisher of the Gloom, Boom and Doom report. I spoke to Dr. Faber from Hong Kong earlier. Mark Faber, welcome to Late Line Business.
It's my pleasure, thank you.
Now, we have $400 billion in Operation Twist, the latest plans to avert a crisis. What do you think this money will be? Good money or money down the drain?
I have been for years highly critical of Federal Reserve policies of Mr. Greenspan and Mr. Bernanke for printing money. But this time around, Mr. Bernanke did exactly the right thing. He didn't increase the balance sheet of the Federal Reserve. He just shifts maturities from holding short-term to long-term assets, in other words, long-term treasury bonds. The only problem I can see with this policy is that when one day in future, could be in 6 months, it could be in 1 year, it could be in 3 years, the Fed will have to increase interest rates. It will be very difficult for them because then they will lose a lot of money on their long-term bond positions. And so they may be very reluctant to adjust interest rates on the upside when it will be necessary.
Is the shift that they have created now something which will make mortgage rates presumably more attractive? Do you think that that will occur, or do you think banks will just simply put up fees and there won't be much of a difference on the ground?
Well, I think that if you look at the interest rate movements over the last few years, specifically after September 2007, when they began to slash interest rates from 5.25% on the Fed fund rate to the current level of 0, the lower interest rates haven't helped the economy at all. It's helped the financial sector, it's helped the banks, but it hasn't helped the man on Main Street. But at least what it does, by not expanding the Fed's balance sheet, it will strengthen the US dollar, and there will be less pressure from the commodity space on prices.
We hear rumours, of course, that there may be more stimulus to come, but we now have this week bank downgradings on both sides of the Atlantic, incredible volatility in the markets too. Do you see a bank crash happening or just more volatility?
Well, I think it already happened. Basically, in 2008, most banks in the Western world went bankrupt. The government came out and bailed them out and provided liquidity to the banking system. What subsequently happened, you can see with UBS, instead of holding subprime loans where they went bankrupt in 2008, they now trade in Greek bonds, Portuguese bonds, index futures and so forth. The banks are basically bankrupt.
Are you now expecting a formal Greek default, and then what happens?
Well, I think the best would be for the Greeks to default, to leave the EU, and there would be then a restructuring occurring whereby everybody who's lent money to Greece, in other words, over 400 billion euros, will have to take a loss. But that's why we have a market economy, that countries and companies that are badly run and are over-leveraged or have borrowed too much, that they go bankrupt, and then the system is cleaned. Otherwise, you never clean the system.
Last month, you called the start of the bear market. What is your outlook for corporate earnings?
I don't believe that the stock market around the world got hit this hard just because of Greece. I think the stock market is discounting something bad globally. I suspect it could be a meaningful slowdown in China and disappointing corporate profits in the United States and in Europe. That's what my suspicion. But it could be even worse. We have big problems coming towards us from the Middle East. The Middle East will go up in flames. And that will have an impact, obviously, on oil prices and on the valuation of financial assets.
Are you talking, when you mention the Middle East, about a political crisis, or are you talking about oil, or both?
I am talking about a social upheaval where regime changes occur, and that the new regimes will be far less friendly towards Western countries, including Australia.
You mentioned China. We, of course, rely a great deal on the China growth story. You're not so optimistic.
Well, basically, if you define a bubble as a period during which you have excessive credit growth and artificially low interest rates, for sure, we have a gigantic bubble in China. I'm not saying that China is finished, but I'm saying that we can have a meaningful setback. And Australian growth today depends entirely on China, not a little bit, entirely. And if China has a recession and the price of copper would suggest that this is happening, then obviously Australia will be hit very hard, including the Australian dollar.
Finally, Mark Faber, where should we put our money to protect our wealth?
Well, I mean, to tell you the truth, and whoever claims that he knows doesn't know. We don't know how the world will look like in 5 or 10 years' time. My advice is you need to diversify in relatively uncorrelated assets. So you own, say, 25% of your assets in real estate, 25% in gold, 25% in equities, and 25% in cash. And with that combination, you have the flexibility. So I think you need to realize we all don't know how the world will look like in 5 or 10 years' time. The best is that we prepare, because we're all doomed. We're all doomed. But we have to prepare our assets in such a way.
It's one of your favourite words, I know. Mark Faber, thank you very much for talking to us tonight.
It's my pleasure.